This is the weekly economic and market update for the week ending November 11th, and I look forward to the week of November the 14th, 2022. And just want to start out with a couple comments about the election. Um, this is significant. What's happened? I don't even know whether the Republicans who had a silver platter laid in front of them, and people are saying Gen Z came in and was able to lift the Democrats. Some are blaming Trump. I don't know, but it was a mess. And regardless, I think that the next 2 years, it's like a ticking time bomb. Next year, we're going to get a deep recession, if not a depression. And half of me says I'd rather have the Democrats left holding the bag, and half of me says, but I don't want the economy to completely fall apart. But we are headed towards a disaster here, and we unless we change our attitude about energy and being realistic about what we can do, around these green initiatives and climate change. It's just like people don't really look at the entire system and just say, well, we'll just get off of oil and, we'll get rid of fossil fuels and coal and those types of things. And Germany's already learned this lesson, so I'm not going to rehash it. I did start a channel called The Deming Lens. It's a editorial that I did back when I was working with the Deming Institute, and it's going to hit some of these subjects really hard, just so people can understand the larger systems at play. That when you just say, well, we just need to get rid of fossil fuels, how stupid that is. And so hopefully those that are ignorant, then it'll educate them, and those that are stupid, well, the only thing that ends that is death. So we'll see what happens with regards to energy. On the oil front, I kind of left a hanger last week on, diesel, and, I don't see anything in the data that I've seen so far that indicates to me that we're going to run out of diesel. There is a shortage, and that's driving the price up. And we are, again, not doing the things we need to do for the short, middle term. I'd say for the next, even to some degree, long term, next 20 or 30 years, we're going to need diesel. You're going to need trucks. And not all of them are going to be battery operated. There's a whole slew of problems with electric vehicles being able to drive distances. And in the cold, there's just so much that people just aren't considering. And we're not building any new refineries for diesel. It's something that this administration has decided that's a good idea. It's going to cause a shortage at some point. I just don't think it's in, the next, month or anything like that. The Russia ban obviously has played a role in this. We're not importing their diesel, so let's just have everything hit at once and make oil and diesel prices go up, and be green about it. Anyway, that's my commentary at the beginning. Let's take a look at investor sentiment here. It has gotten more bearish as of Wednesday night. I think a lot of people were a little surprised at what happened with the elections, as I was. But, it is what it is. So, if people want to run a country this way, the bright spot obviously was Florida. But we've gotten more bearish. I think that's probably will have changed from some of the things I'll be talking about here in a minute with regards to the CPI, which I predicted last week, what the reaction would be. Not that I'm alone in that. Just a very sensitive market. Let's just put it that way. So anyway, people have got, as of Wednesday night, they had gotten more bearish. And if we look at the fear and greed index, you'll see that people are definitely more greedy than they were even a month ago when it was extreme fear at 18 first. So that's the kind of the investor sentiment types of data. Let's look at well, one of the things that I want to talk about is the CPI. Before I look at that, let's go back for a second. And that was the CPI was really was everything this week. That was the market mover. And when it came out, take a look at the numbers here. With an expectation of 8%, the consensus was that it'd be 8%. Previously, it did an 8.2%. When it came out, excuse me, at 7.7%, I knew the market was going to just explode, and it did pre-market, and continued throughout the day. And if we look at some of the indices, Dow Jones, in one day went up 1,000 points. I mean, that's a move, or 1,200 points, excuse me. And if we look at SPY, it was up quite a bit for the day, and finished up even today, Friday, the 11th of November. And what I'm looking for here in these markets, I'll talk about this a little bit more at the end, but there's some additional moves that need to happen to kind of break this bear market trend that we're in currently. So we'll save that towards the end. And so let's look at some of the economic data this week. Other than the CPI, the only other thing, it really wasn't a market mover, maybe had a little bit of an effect, was consumer sentiment. It had previously was 59.9, and the consensus was that it would stay there, and it went down to 54.7. So that's a move. My expectation is this continues to move lower here, but nothing ever meets necessarily my expectations. It does what it's going to do. Let's take a look at let's go ahead and take a look at some of the other kind of key figures over here. The 10-year that I put now using this chart, it dropped precipitously, which is obviously helpful on the day that the CPI came out. Now, whether that's an overreaction or not, it kind of bottomed out here at about 3.81%, but that's a significant, was that drop from a high of 4.11, almost 4.12%, all the way down to 3. That's the 10 years, these treasuries typically don't move like this. They move in these like little candlesticks like here. But look at that. You don't see anything like that on this chart. So anyway, that's good news from one perspective, that, mortgage rates and things like that will lower. DXY, just look at that drop. That's like a falling knife at the moment. And this comes with double-edged sword. Again, these are things that drive the markets higher. And that's the good news. But the bad news is, as the dollar drops, all the things that we import are going to cost more. So you can look for inflation. So it's just kind of like, one thing on top of another. Crude has recovered. It was down around $76 a barrel. Now it's running, 88, a little over $88 a barrel. So it's kind of making its way back up also. But again, I think these things will get hit with the price of the dollar coming down, and China's supposedly coming back online, and so you might see some increase with regards to oil And then, another indicator that I use, you have the VIX, which is a volatility index. And as it falls, typically, and that it's kind of bucked the trend a couple times, just like everything else in these markets. But as it goes down, and you can see it's in a downtrend here, gets below $20, then volatility relax it. But it also tends to, as the VIX falls, the market increases. So all of the Dow Jones and the S&P and the NASDAQ all will benefit from lower volatility typically. So that's a look at the markets. If we look at next week's economic calendar, the thing that I'll be looking at on Tuesday will be the producer price index. The expectation here is that a 0.5% increase in the producer price index. Get less than that, obviously that helps, but this isn't a big market mover as some other things. And let's also look at retail sales. I think we'll take a look at it. It's got to move significantly in order for it to be a market mover. And then obviously housing starts, all the housing types of data come out, building permits, existing home sales. Those will be, those will move the market some. But we had the big catalyst today, and that was the CPI report. So that's the thing that's happening. Now, going back to these charts, these are just kind of my final comment on this is if we look at the Dow Jones, for instance, okay, so you can see we came down very low here, but this is the level I'm looking at, 34,145. We're obviously making higher highs here than in this downtrend that I have marked on here that happened really almost since the beginning of the year. But you can see that we're starting to get close to going past that. If that happens, that's kind of my first indicator that this thing's going to make its way higher. It doesn't happen all at once typically. And then my next level here is going to be up around 35,530, and then now we're back in all-time territory. And if David Hunter's contrarian forecast happens, and now there's more people talking about it, that this is this start of a bull run here. Now David Hunter thinks that it will go way beyond I think his numbers are 45,000 Dow. I mean, from where we are, that's like more than a third, probably 40% increase that's out there. And for SPY, interest rates obviously affect this, but looking at 412, I start to get a little bit more excited. It has been a good move from the bottom here, back up, and there'll be ups and downs, but I'm looking for this number right here around 432 for me to get really excited again. If it starts to hit those numbers, then I think you start to make your way back up to all-time highs. And again, if you have the collapse that David Hunter's predicting at the end of the fourth turning, a great book, by the way, that's things cycle every 80 years, and there's good and bad to it. But the end of the cycle being a melt up, and what did I say? 45,000 for the Dow was David Hunter's prediction. The S&P 600 from where we are right now, so that's a 50% increase, and then a precipitous drop of 80%, something that I, you know, people like Peter Schiff are going to say that we're headed there now, but I don't know. We'll just have to, these are the times when I keep telling people, familiarize yourself, put in your repertoire that you at least understand the options. The movement here is all on price action and short-term investments. The longer term you go with some things that you would typically do in an up market are things you can't do when you have high volatility like we have now. And looking at draw a line here. Something along that line. We've been in a downtrend for a while, so I said we break here, break above this line, maybe step 1, step 2, step 3. I think once you hit here, then you're probably going higher, and the melt up is probably what David Hunter's talking about will happen. So anyway, that's my final comments on this, and educate yourself. It's been wild times, more coming. Don't plan on the market just going up, as people say, well, the market always goes up. So even, I don't know that will be true if we get the melt up and then an 80 or 90% collapse from there. You may be decades. I'll be long gone before it starts to hit new highs again. Anyway, that's what I wanted to cover this week. And remember, there is always a better way.